Hi, welcome to the Market Alert for Wednesday the 24th of May 2017. So yesterday, a very quiet day, and there are two reasons for that. First, the market waiting for the FOMC minutes, which will be released at 7 PM BST today, and also the low volatility, which we'll come to in a bit. And again, we find ourselves in the position that we were 2 weeks ago. And again, as we go into the market alert, I'll show you why, and why it's probably wise to stand aside or paper trade at the moment. So let's have a look at yesterday, and again, this will reinforce what I'm going to show you later on. So we had a potential sell signal. The market moved lower, no surprise, because this has been the pattern for an awful long time now. Move the market lower to begin with, and then bring it back. Now, because of the low volatility levels at the moment, the market is having difficulty breaking major support levels. Here you've got the 20,900 level, and you can see the market coming down to it. It touches it, it moves back. So that's the first thing that you've got to notice here. If the market doesn't take out these levels following a short trade down to the scalp, then we have a problem. So as soon as you see this on the first bar that hits a support line or a resistance line on the upside, as you can see here, then we're going to have an issue. And this alerts you to the fact that, maybe you should reduce the risk by moving the stop, or take the money that's on the table at this point, because the market is struggling to go lower, and that is because of the low volatility and momentum in the market. So let's move forward a bit. You'll see the market are waiting for the new home sales there. They came out worse than expected. So the market drops. This time it trades through, but then immediately it is brought back towards the entry price there. And once again, take note, we had 1 here, 2 here, 3, market coming down, coming back. We've now got a resistance there as well. So we're going to need something to drive through to move the market back as well. We've got 3 points there where the market came back. Also the option to get out at break even at this stage as well. The market goes back down again, and now we've got a potential buy signal. The market also, you will notice, went through on this bar and then back through on this bar. So we'd broken through and then come back. So again, it's indicating to us that there's no direction. There's a bit of a battle going on with those that are trading, which direction they want the market to go. And then we'll see the market starting to move higher at the 20 bar moving average there, back down sideways, and then eventually the market moves up to the stop. Now, I sent a note out again warning you of this, that the market was failing to take out the support, and there you'll see the market coming back. Same pattern, plunge protection team involved. And then, as I said, the evenings, Tuesday evenings, I don't trade. And you can see the market's already been sideways. If I'm just going to wind this back a bit, so you can see, we've got a 50 point range from here down to here, and you can see that we've done 50 points in the first hour. And then once the market became sideways, you can see that it's range bound with far less points there, around 30 to 35 ballpark. So in the evening session, the market sideways. You can see 2 signals there that were not filled because of how sideways the market is, and now it's really sideways. Here we have the market trading up to the 20,950. The market goes through, but then has no momentum to continue through. You'll see it coming back, and then price is trading sideways to lower in the latter part of the session. Just a range bound market there. So let's have a look and see where we are on the overnight market. Very, very quiet, and the reason for this is once again that the market is waiting for the FOMC minutes. So in the daily chart, again, you'll see how quiet things are. Market barely moving yesterday. The volume is incredibly low. You can see there for the last 2 days the volume has been negligible. market stuck in a range. It's traded up to the 76% that I drew in on Monday. It's struggling with this area. Again, you can see how well that actually works. The market took out the 20,859. So let's remove that. Let's also remove this and just clean up the chart a bit so we can see exactly where we are. I'm just going to remove these until the market turns around and moves lower. We'll also remove this so it's a lot cleaner to look at there. And then we'll just save that as well. So the market, if it intends to actually move higher, it's got to break through this area. It's got to drive up towards here, which is 21,073 and 21,172 for the all-time high. That's the all-time high in the Dow. The S&P is currently flirting with the all-time high, but that's the all-time high for the Dow. Economic news today, let's have a look. Draghi's out at 145. Dow's closed. Existing home sales at 3 p.m. Crude oil inventories at 3:30 p.m. And then of course we've got the big one at 7 o'clock, which is the FOMC meeting. But it looks like forecast to keep rates unchanged, and then Kaplan's out at 11 p.m. So again, expect the market to be fairly quiet because of the lack of news. The pound yesterday, well, there was no trades that were actually filled, but if we go into indicator settings and left click on show unqualified, you will see that we had 3 potential signals there, and 1 there, 2 and 3, and the market never filled these, and that's because the market was quiet, and that's probably due in part as well to the tragic events in Manchester as well. So very, very quiet for the pound yesterday. Incredibly range bound day. So let's have a look at the implied volatility, and you'll see why we're not getting anything any momentum at the moment. So in the implied volatility, you can see how quiet things are. We've got 832 for yesterday, down from 859, and we have this back in the lows. You can see when the implied volatility gets down to below 9, then you get losing trades in the Dow. It's as simple as that, because the market is so quiet, there's not enough momentum to actually move once the signal is generated. And this is great news, because there's no other trading strategy out there that actually tells you that you should think about standing aside until the volatility picks up. And that's what the implied volatility is telling us here, that the market is particularly quiet. There's nothing wrong with paper trading, and if you want to go in and do it, you've got to be aware that if the signals are generated near support and resistance lines, then you've got to just take pennies off the table. But is it worth the risk? That's the thing you've got to ask yourself. I can't say whether you should or you shouldn't, because everybody has a different risk threshold and the way they actually view the markets. I'm quite happy to sit in my hands and wait for things to turn around. 25 years has taught me that sometimes it's just best to sit on the sidelines and wait. Now the good news is, that's the bad news out of the way, the good news is that these markets always break, and as we saw last week, once the volatility breaks, then we get a big spike, and then we had a good 70 odd points on the trade. So instead of having losing trades and trying to and getting frustrated and bored watching the market, then just wait for it to break, because it always does, it always will. And as we go further into this summer, within the next few weeks, trust me, there's going to be a lot of volatility. These levels we've not seen since 2007, 2008, and we all know what happened then. We've had record lows in the volatility index, 17 days, consecutive days of the VIX below 11 as well. So again, we know what's coming. The problem we've got, and I'm just going to switch to a few news items for you, and you'll see exactly my sentiments are being echoed also by a lot of the big guns in the markets as well. This is what I've been barking on now for years, but it's interesting to see how a lot of the banks and also big players are coming out and saying the same thing too. So here we've got legendary investor Asher Elderman saying, "I have no doubt that the PPT behind market rally." What he means about this, for those of you that are new to PPT. It's nothing to do with this PPT. This is Pinpoint Trader. This PPT that he's talking about here is the plunge protection team set up in 1988 by Ronald Reagan after the 87 crash to actually support the market. And this is exactly what's been happening. That's why we have that same pattern of the market moving lower in the first part of the session to only then find prices being brought back. We've seen this for many years now. Once the QE had stopped, then in order to keep the market on the highs, the plunge protection team, the Fed's trading desk, is basically what it is. If you have a look on Wikipedia, it explains all of the details there. We'll come into the market and bring it back, and that's what we've been seeing. And that's why even when we had the 300-point drop last week, or the week before actually, with this Russian nonsense with Trump, and impeachment prospects, which is all vanished now, you'll notice, then the plunge protection team have been back into the market and they've brought the market back. Well, what a surprise. It's something that they've done for a long time. And again, here's another one for you. We've got stocks near record highs as economic data crashes to 15-month lows, again reminiscent of 2008. And even Goldman, they've come out and said we have entered a slowdown phase, but stocks don't care. And the reason they don't care is because the plunge protection team keep bringing the market back. But at one point and at one time, as Elderman says here, I don't want to be in the market because this is not about holding stocks. This is not about trading the markets. I don't want to be in the market because I don't know when the plug is going to get pulled. The government's plunge protection team is the only thing propping up the current market rally. And he's absolutely right. The market's up on fresh air. From December I've been talking about this. The big guns are out of the market, not only from what I've seen and the analysis that I've done way back in December. They're definitely out of the market, but that was confirmed in many articles from the Bank of America as well, that the retail investors are those that are getting into the market and the big guns are out of the market. And on that cheery note, that will do it for today. As ever, thanks for watching. I shall see you in the next one, reporting if there's anything to report in about today. But again, just heed the warning. Get the plunge protection. The FOMC minutes are out later today, and the market could be quiet in the first half of the session, waiting for that. And don't expect a big reaction from it either, because in times gone by we only needed the prospect of a meeting and we got a 100-point swing either way. Now when they release the minutes, we're lucky if we get 20. So again, it could be a non-event today, and that again you'll know now is because the volatility levels are so low in the implied volatility. But as I say, take heart. The good news is this is, and we had a taste of it a couple of weeks ago, that once it breaks, then we get some decent moves in the markets. Right, that's it. See you in the next one.